You decide to take £10,000 from your pension. It's your money. You've saved it over decades. You've earmarked it for something specific, a new boiler, help with a grandchild's deposit, a holiday you've been putting off. The money arrives in your bank account, but it's not £10,000. It's significantly less, and the shortfall has gone to HMRC. Here's what happened. Your pension provider didn't have your current tax code, so they used an emergency one. And that emergency code applied a rule called Month 1, which assumed that the £10,000 you just withdrew is going to be repeated every single month for the next 12 months of the year. On that basis, HMRC calculated your annual income as £120,000 and taxed you accordingly. You were owed $10,000. You received considerably less. The difference sits with HMRC waiting for you to claim it back. This is not a rare edge case. Between January and March 2026 alone, more than 13,900 UK pension savers filed claims to recover overpaid tax on pension withdrawals. HMRC repaid £44.1 million in those 3 months. The average refund was £3,100. Since pension freedoms were introduced in 2015, more than £1.6 billion has been reclaimed by people who were overtaxed on their pension withdrawals. £1.6 billion that could have stayed in people's accounts and didn't because the system applied the wrong tax rate and nobody told most of those people how to get it back. Stay with me because 2 things decide whether you're in this group and what to do about it. The first is the Month 1 mechanism, why it happens and who it affects. Because the answer is not just people who took a one-off lump sum. It also catches people who started drawing a regular income from their pension for the first time. The second is the right form. There are 3 separate claim forms for this specific situation. Pick the wrong one, and your claim bounces back without a refund. I'll show you the decision tree in plain English so you can pick the right one in about 30 seconds. Okay, the basics. Since April 2015, most UK pension savers with defined contribution pension pots, money purchase pensions, personal pensions, SIPPs, have had the freedom to access them flexibly from age 55. That age rises to 57 from 2028. You can take some out, take it all out, or take a regular income. You can also take up to 25% of the value as a tax-free lump sum. The taxable portion, the rest, is treated as income for the year. When you access your pension flexibly for the first time, your pension provider needs a tax code to know how much income tax to deduct. In many cases, HMRC doesn't send that code until after the withdrawal has already happened, so the provider uses an emergency tax code as a placeholder. The emergency code works on the Month 1 basis. It divides your entire personal allowance, £12,570 by 12, and applies 1 month's worth of allowance to your withdrawal. It then taxes the remainder as if you're receiving that same amount every month of the year. So a £10,000 withdrawal is treated as though your annual income is £120,000. Your tax bill is calculated on that basis. The amount deducted can be dramatically higher than the actual tax you owe on a one-off withdrawal. In practice, the majority of people who access their pension for the first time are overtaxed, in some cases by thousands of pounds. The good news is that HMRC has a fast-track process to reclaim the overpayment. Within 30 days of a correctly completed claim, the money is refunded by bank transfer. You don't have to wait until the end of the tax year. You can claim during the same tax year you made the withdrawal. One important change from April 2025 to be aware of: HMRC updated its process so that tax codes are now more quickly communicated to pension providers when someone newly starts receiving a private pension. This has reduced the scale of the problem going forward, but for anyone who accessed their pension before April 2025 or whose provider systems didn't update quickly enough, the emergency tax problem remains very much alive. So how do you know if this applies to you? If you have made a flexible withdrawal from a pension pot and the amount that arrived in your account was noticeably less than you expected, check your refund entitlement. Your pension provider will have sent you a P45 showing the amount paid and the tax deducted. If the tax deducted looks disproportionately high relative to your normal income, you are probably on an emergency code, right? The 3 forms. This is the part that trips people up. There are 3 separate HMRC forms for reclaiming overpaid tax on pension withdrawals, and using the wrong one means your claim is rejected. The right one depends on 2 questions. First question, did you take out your entire pension pot or just part of it? If you took out only a portion, some, not all, and you are not planning to take further payments from the same pot before the end of the current tax year, your form is P55. This is the most common form for people who took a one-off partial lump sum. If you took out the entire pot, emptied it completely, the answer depends on the second question. Second question, do you have other taxable income in this tax year? Other taxable income means your state pension, any other private or workplace pension, any earnings, any taxable savings interest above your allowance. If you emptied the pot and you have no other taxable income, your form is P50Z. If you emptied the pot and you do have other taxable income, your form is P53Z. And there's a fourth situation. If you took a small pension lump sum from a pot worth £10,000 or less, what HMRC calls a small pot or trivial commutation payment, your form is P53. Read those 4 options through once more, because the right form depends entirely on your specific situation. Go to gov.uk, search for pension tax refund forms, and you'll find all 4 under the relevant HMRC guidance pages. For all 4 forms, you'll need your national insurance number, your bank details for the refund, and parts 2 and 3 of your P45 from the pension provider. Without the P45, HMRC cannot process the claim. If your provider has been slow issuing it, chase them directly before submitting. HMRC aims to process claims within 30 days of receiving a correctly completed form. Refunds are paid by faster payments directly to your bank account. If you provided estimated figures because final figures aren't yet available, HMRC will check at the end of the tax year and make any necessary adjustment. There is one thing I have to flag before you claim, because it catches some pension savers out completely. It is called the Money Purchase Annual Allowance, or MPAA. When you access your pension flexibly and take any taxable income from it, a particular rule kicks in. Your annual allowance for future pension contributions drops. Not from the current £60,000 standard annual allowance to something slightly lower. It drops all the way to £10,000 per year. This is permanent. Once triggered, it cannot be reversed. So if you are still working, or if you plan to go back to work and start contributing to a pension again, you need to understand before you access your pot that the MPAA will be triggered. Future pension saving after that point is capped at £10,000 a year, regardless of what your employer or you would like to contribute. The MPAA is not triggered by taking your 25% tax-free lump sum alone. It's only triggered when you take taxable income from a flexible arrangement or take an uncrystallized funds pension lump sum, the type where you take part tax-free and part taxable in one go. If you're close to retirement and don't plan to contribute further to a pension, the MPAA is irrelevant. But if you're in your 50s and there's any chance you'll want to save more into a pension later, understand this before you access. Now, what if you haven't claimed yet, but you made a flexible withdrawal years ago? You can still potentially claim. HMRC allows you to reclaim overpaid income tax for up to 4 complete tax years. As of the 2026/27 tax year, That means you can still claim for 2022/23, 2023/24, 2024/25, and 2025/26. The 2022/23 window is already closed. The 2023/24 window closes on the 5th of April 2027. So if you withdrew from your pension in 2023/24 and were overtaxed, you have until that date to reclaim it. If you complete a self-assessment tax return, you can also include the overpayment claim in your return, rather than submitting a separate form. Either route gets you the same refund. One quick protection before we close, because pension access scams are common and becoming more sophisticated. The real HMRC will never call you unsolicited to offer to speed up your pension tax refund. They will not text you a link to verify your withdrawal. They will not ask for your bank details over the phone before you have submitted a claim form. Genuine refunds only happen after you have submitted a correctly completed form to HMRC. They are never offered to you out of the blue. Pension liberation and pension scam fraudsters often target people who have recently accessed a pension pot and may be expecting a refund. If you get a cold call, a text, or an email about your pension refund, it's a scam. Hang up, delete it. If you're unsure about any communication you've received, call HMRC directly on 0300 200 3300. So, 2 things to do. First, if you've made any flexible withdrawal from a pension pot since 2015 and the amount you received was lower than expected, check whether you were on an emergency tax code. Your pension provider's P45 will show the tax deducted. If it looks disproportionately high, submit the right form. The refund is yours, and 30 days after a correctly completed claim, it's back in your account. Second, check the 4-year window. If you made a withdrawal in the 2023/24 tax year and haven't claimed, the window closes in April 2027. That's close enough to act on now. This is the 12th video in this series, and we've now covered the most important benefits, tax allowances, and overpayment corrections available to UK pensioners and their families. From pension credit to attendance allowance, from the winter fuel payment to the married women's underpayment. Every video has been about money that belongs to you, that the system has either failed to pay automatically or made it unnecessarily hard to claim. There is one final topic that deserves its own dedicated video, and it's the one that sits underneath all the others: scams. In the UK in 2025, over £500 million was lost to fraud targeting older people. Pension scams, benefit scams, fake DWP texts, HMRC impersonation calls, attendance allowance, claims handlers, charging for a service that is free, winter fuel payment phishing messages. Every benefit we've covered in this series has a corresponding scam targeting the people who'd claim it. That's the next video. A dedicated guide to the most common scams targeting UK pensioners right now, the exact warning signs for each, and the specific things to do and never do when something arrives that looks like it might be official. Subscribe so it lands in front of you, because the scammers stay current even when we don't. This channel is for general information only. We are not affiliated with HMRC, the DWP, or any government body, and nothing here is personal financial advice. All figures are current at the time of recording and can change, so always confirm your own situation at gov.uk or with a free advisor such as Citizens Advice or Age UK.